In this video, we look at an overlapping generations model in which we introduce automation. So that's kind of analogous to the video on the Solow model where we introduced automation, but we will see here that very different results come out of such a framework. With this, we can then solve a puzzle that exists in the literature, namely that automation leads to growth and is growth enhancing in the Solow model and in the Ramsey-Cass-Koopmans model, but others have found that automation can actually lead to immiserization. What we show is that this result actually pops up in an overlapping generations framework with automation, and we explain why this is the case. The articles that are relevant in this context is the one by Steigum, Robotics and Growth in Frontiers of Economics and Globalization, Economic Growth and Development. Then a paper by Sachs and Kotlikoff, Smart Machines and Long-Term Misery. And a paper by Gasteiger and Prettner, Automation, Stagnation and the Implications of a Robot Tax, that is forthcoming in Macroeconomic Dynamics. A textbook treatment of this aspect can be found in Chapter 5 of the book by Prettner and Bloom, Automation and its Economic Consequences, Theory, Evidence and Social Impacts. Before we start, this figure is a reminder that automation is a rather new phenomenon and that it became increasingly important over the last 10 years. So here we see the global operative stock of industrial robots as reported by the International Federation of Robotics. For the year 2020, these were predictions back then. And we see that from 1970 onwards until the mid-1980s, the stock of robots was basically negligible. Then growth increased, but at a rather sluggish rate until the year 2008, 2009. But after the global financial crisis, actually growth in industrial robots took off, and we saw growth rates per year of about 10 to 15%, which is of course faster than growth in per capita GDP in all countries or growth of the labor force for that matter. So automation is gaining importance, and that's also the reason why it has been analyzed in the literature most recently in a quite intensive way. Now, what has the literature shown up to now? Well, Steigum, in a very interesting paper in 2011, showed that automation has the potential to lead to perpetual growth in the neoclassical growth model. And in the chapter on the Solow model with automation, we have seen that this also holds true in the Solow framework, basically. In general, the literature seems to be in agreement that automation leads to faster growth in some sense, and in some frameworks growth even becomes only possible with automation if there is no technological progress. Then that automation leads to a declining labor income share, so it can explain part of the declining labor income share we have observed since the 1970s and 1980s, and it can imply rising wage inequality. Now, however, a paper by Sachs and Kotlikoff in 2012 and some follow-up papers later on found that automation can also lead to immiserization. Most of these results are based on numerical simulations. Now, this kind of stands in contrast to item 1 here. And what we will show is actually that this hinges on the underlying model structure in the background, because the overlapping generations framework actually leads to a different prediction on the effects of automation on long-run growth than the neoclassical growth model of Ramsey-Cass-Koopmans or the Solow-Swan model. So the aim of this chapter is to propose an analytically tractable overlapping generations model with automation, and use this framework to explain why this result emerges that automation can lead to stagnation in such a framework. And as a third item here, what we will also do is to analyze the extent to which a robot tax could reduce immiserization, or the extent to which a robot tax at least could increase welfare. Now let's start with the basic assumptions. We again have an overlapping generations economy, so time refers to generations and evolves discretely starting at 0 up to infinity. Individuals again live for 2 time periods, and decide how much they want to consume and save in the first period of life when they earn a wage income on the labor market, and in the second period they live out of their savings that they earned in the first period. The workforce now, in contrast to the baseline version of the model, grows at rate n, such that the cohort in time t plus 1 is larger by a factor of 1 plus n than the cohort that was on the labor market at time t. Now, in contrast to the basic model we have encountered so far, there are now three production factors. So we have labor, the workers in the economy. We have a traditional physical capital, so the machines, buildings, production halls, and assembly lines, and so on. But we also have automation capital, the industrial robots, the 3D printers, and algorithms based on machine learning, whatever can perfectly substitute for labor. And now capital depreciates fully over one generation, and this refers to both types of capital. So traditional capital and automation capital both depreciate fully over the course of one generation. The consumption side of the model is actually quite similar to the baseline version of the model, so we can be brief here. Utility is additively separable in the two time periods and is derived from consumption in the first period and consumption in the second period. Again, the utility function is logarithmic, and second period utility is discounted with the discount factor beta, that is between 0 and 1. The higher beta is, the more patient individuals are, the more weight they put on second period utility. The budget constraint is also as before, so we have that wage income when people supply their labor on the labor market has to cover the consumption expenditures over the life cycle. So that's consumption expenditures in the period when individuals work, and discounted consumption expenditures in the period when people are retired, and the discount rate is again the market interest rate. So we already know that this leads to the optimal consumption savings choice, where people consume a fraction of their wage income in the first period and also save a fraction of their wage income in the first period for second period consumption. What is new, however, is now the additional production factor of robots, of automation capital. So we introduce a Cobb-Douglas production function again, where we have aggregate output denoted by Y, depends on capital, the traditional capital stock, machines, assembly lines, production facilities with an output elasticity of alpha, and on labor with an output elasticity of 1 minus alpha. But again, as in the chapter on the Solow model, we have the automation capital stock that is a perfect substitute for labor in the production process, because these are the industrial robots that are in the strict definition of automation capable of substituting perfectly for a worker. Well, in this case, we have three factor rewards basically, but two of them are the same because workers and robots are perfect substitutes. So wages and the rate of return on robots must by definition be the same. Again, we have perfect competition, so the production factors are remunerated according to the marginal product, and we can compute the wages as the derivative of the production function with respect to the production factor labor. If we do so, we get 1 minus alpha down from the exponent. We get the exponent reduced by minus 1, so we would have minus alpha here, but that is again the same as writing k to the power of alpha in the numerator and L plus P to the power of alpha in the denominator. So that's now the wage rate, but it's also the rate of return on automation capital, because they are perfect substitutes. And we would see this if we take the derivative of the production function with respect to PT, we would arrive exactly at this result too. And the rate of return on traditional capital is the derivative of the production function with respect to traditional capital. We see alpha comes down, L plus P to the power of 1 minus alpha remains here, and then we have K to the power of alpha minus 1, so we can write this in the denominator, and we have this expression here. Now, what the implications of automation and capital accumulation are for the factor rewards, we see it here. So if traditional capital accumulates, so KT increases, well, this implies ceteris paribus that the wage goes up, because traditional capital and labor is complementary to some extent. and the rate of return on traditional capital goes down. That's also clear because the marginal product of traditional capital is decreasing. This is rather standard. What is not standard now is the effect of automation. So if automation capital accumulates, then ceteris paribus, this would actually reduce the wages because the robots are perfect substitutes on the labor market for the workers. But the capital rental rate on traditional capital would actually increase because now robots and traditional capital are to some extent complementary, and you could think of an assembly line that is staffed by industrial robots instead of workers. Now, in the overlapping generations framework, there is the basic assumption that households invest optimally. So there are conscious households making an optimal savings decision, and that means there are also rational investors deciding rationally how much to invest in traditional capital and how much to invest in automation capital. Now that implies that in an interior equilibrium in which investors invest in both types of capital, the no arbitrage condition has to hold, that the rate of return on traditional capital and the rate of return on automation capital has to be the same, here expressed in terms of the interest rate because the rates of depreciation are the same. So the interest rate on traditional capital has to be the same as the interest rate on automation capital, and we just denote this from now on by the interest rate in the model by lowercase r. Now, if we set these two rates of return equal to each other, we can again derive the implications for the optimal factor inputs that we already had in the Solow model, where automation capital depended positively on traditional capital, because if there are more assembly lines, you need more either workers to staff them or industrial robots to staff them. So ceteris paribus, the demand for industrial robots would go up. But by contrast, if we have more workers in the economy, this would reduce the incentives to automate, because if you have a lot of workers, then there is no need to automate. The wages are generally comparatively low, and all that reduces pressure to automate. So again, this equation has to hold. And when we plug it into the production function, we would again get this AK structure of the production function, where the diminishing returns with respect to capital are eliminated. So then the aggregate production function becomes linear in traditional capital. And the superficial conclusion now would be that perpetual growth is possible in such a model. Because, for example, if we rely on standard AK growth models, we know that perpetual growth is possible. Or if we rely on the Solow model with automation, then we also saw that perpetual growth is possible there. So here we would also probably at this point say, well, this has the same structure and therefore perpetual growth should occur, or it should be able that perpetual growth occurs. However, we will see now that this is not the case in an overlapping generations framework. To see this, one would write down the law of motion for the accumulation of aggregate capital, which is now again the sum of traditional capital and automation capital, and that has to be equal to aggregate savings multiplied by the size of the cohort of workers, because they save. Now we can plug in all that we've already derived on the previous slides, the saving rate, that is basically from here. Then we have the wage rate that we have to substitute out from here, and so on and so forth. And if we do all that, basically, then we arrive at an aggregate capital accumulation equation where we can substitute out for robot capital because of the no arbitrage condition. So we also use this equation here when substituting out for robots. And then in the end, we would divide by the number of workers to get the accumulation equation for capital per worker. And now we see immediately when looking at this equation that no perpetual growth can be possible because capital per worker does not accumulate. These are all exogenous parameters, so there is no growth in the capital stock per worker. And this is a striking result because on the production side, we had an AK structure of the model. So one would, from this perspective, conclude that perpetual growth should be possible. But in equilibrium, it is not. Now, what is the explanation for this finding? Well, in the neoclassical growth model and in the Solow model, individuals saved and invested out of labor income and out of capital income. So individuals in the Solow model save a fraction of total income, which is GDP, and therefore they also benefit by higher capital income and can save more because of higher capital income that might be due to automation. And the same holds true in the neoclassical growth model, because there individuals also start immediately by accumulating capital, so they have immediately capital income available to save. Now, that means that investments benefit exactly by the increases in capital income that automation implies. Automation raised the rate of return on traditional capital, and therefore these people who save also benefit from automation to some extent, although their wages decrease. In the overlapping generations model, by contrast, individuals save exclusively out of labor income, as we discussed in the baseline overlapping generations model. However, labor income is reduced by automation. So if more robots are present in the economy, we have seen that this reduces wage income, actually. So that also means that savings are reduced and investments are reduced. So actually automation holds back investment, and thus ongoing capital accumulation in such a model cannot occur. So the basic explanation is the demographic structure and the timing structure of the model, that the young workers solely depend on wages in order to save, but their wage rates decrease in automation, and therefore there is kind of a cycle, and the economy cannot escape this stagnation equilibrium again, because as soon as automation starts, wages are held back, and then there will be no investment anymore in automation, and so on and so forth. Now one might think that this is rather kind of a strange result that might be due to the very special assumptions of the basic overlapping generations model. We know we used logarithmic utility functions and the Cobb-Douglas production function and so on and so forth. So one might ask what happens when the model is generalized. So here we generalize the model to allow for an isoelastic period utility function. So it's not logarithmic anymore, but we have an additional parameter that determines the curvature of the utility function, theta. And therefore, substitution effects and income effects do not necessarily cancel each other off. So we can have the effect that the interest rate has impacts on the consumption savings decision of households. And in addition, the second modification is that we allow for a more general constant elasticity of substitution production function, where automation capital and labor are imperfect substitutes and not necessarily the perfect substitutes that we used in the strict interpretation of the term automation. So that means we would have actually the same production function as Steigum allows in his 2011 paper, where output is produced with traditional capital with an output elasticity of alpha, and now labor or robots, but they are not perfect substitutes, but the elasticity of substitution between them is determined by the parameter mu. So therefore we could have the situation that if a robot is employed, then you don't fully substitute for workers, but you also need additional workers to some extent. As we already discussed when we talked about the baseline model, if we generalize the framework in terms of the utility function and the production function, then the price for this is that we cannot solve the model analytically anymore. So we have to resort to numerical simulations, and that's exactly what we do here. So we simulate the model for the following parameter values. Alpha is 1/3, a standard parameter in the literature, beta 0.6, the population growth rate 0.25, all very much in line with what we can observe in the data. Mu is 0.5, which would imply that industrial robots and workers are gross substitutes, which is arguably the empirically relevant case. Nu is 0.1, so a 10% automation share. and theta is equal to 2, so that's the parameter that determines the curvature of the utility function, implying that the intertemporal elasticity of substitution is 0.5. And again, that's the empirically relevant case where people are not so willing in general to substitute consumption intertemporally because they are risk averse. Now, what do we find when we run the simulations? Well, we see here the capital stock per worker and here time, and we see the economy converges into this stagnation equilibrium again, where the capital stock per worker does not increase anymore. And the same holds true for output per worker. So for realistic parameter values, the model still implies stagnation. So it's not the case that the implications of stagnation, even in the presence of automation, only held true for the very special assumptions of a logarithmic utility function and the Cobb-Douglas production function with a perfect substitutability between automation capital and workers, but it also holds true in a more general case. Another objection would be that the results are fully due to the fact that we do not allow for bequests in the model. So as we discussed in the baseline overlapping generations framework, bequests are not allowed. So therefore, people always start out without any capital, so they don't have capital income. And as we've discussed, this is actually the problem why no perpetual growth can emerge in the case of automation. But what would change if we allowed for bequests in this setting? So what we do is to introduce a dynastic utility function now, so where people have a certain amount of altruism towards their offspring, so they want to bequeath them something for their lives later on. So what we do then is we take the sum over all the utility functions of the different individuals and the life cycle. So this is the individual life cycle in the first period of life and the second. And then we take the sum over that. So we link the generations by means of intergenerational altruism. So we assume a discount factor also of intergenerationally of beta. Then we have the population growth rate entering this positively, because if there are more children later on, then aggregate utility of such dynastic planner would actually increase. So that's kind of Benthamite utility specification. And phi measures the extent of intergenerational altruism. So if phi is equal to 0, people are perfectly altruistic to their offspring, meaning that they treat their offspring as if they were themselves. And if phi is positive, however, so they discount the utility of the offspring as compared to their own utility. Now what we find is that perpetual growth is possible in such a setting, but only if the intergenerational altruism parameter is actually negative. So that means that people value utility of their children much more than they value their own utility, basically. And that would mean, counterfactually, that people could increase their utility by just postponing consumption into the future. They would not consume, but just postpone consumption and bequeath to their children. So that's not arguably the empirically relevant case. Now, the question might emerge why this result actually obtains when we could view the Ramsey-Cass-Koopmans model actually also as a dynastic utility specification, where just the periods become smaller and smaller, so the changes between periods in terms of time. However, the problem here is that the first period in the overlapping generations model actually doesn't last only for 1 month or something. It's a very long period. It lasts for 25 years. So in the first generation, actually already, people would need capital to save out of their capital income, and to induce a high enough capital stock in the first period such that this process ignites to some extent, one would have this negative coefficient for intergenerational altruism. So also this generalization does not lead to a situation where we would get perpetual income growth in an overlapping generations model for realistic parameter values. A final aspect that we want to analyze in this context is whether a robot tax could change the results. And to this end, we assume that a tax tau is set by the government on robots and it is paid by firms. So the governmental revenues are then the price that firms pay for the robots, which is the robot capital rental rate multiplied by the number of robots that the firm employs, and this is multiplied by the tax rate, so we have governmental tax revenues, and we assume that they are redistributed to the households, so we add them to the wages. And basically one could surmise that if we tax robots, then this reduces the effect that robots have on wages, and therefore it might be possible to have perpetual growth in this setting, particularly when we give the revenues of that to the young generation that wants to save and that needs the capital income to save for perpetual growth. Is there anything that changes in this context? Well, if we now simulate the model again for the same parameter values as before and the robot tax rate of 50% actually, then still the economy converges towards constant capital stock and constant per capita GDP. So from this perspective, nothing actually changes. There is still stagnation in the framework, irrespective of the fact that we have a robot tax that is redistributed in a lump sum manner to the households. What we can show, however, is that the robot tax might have a positive effect on welfare. So what we compute here and show graphically is the compensating variation after the introduction of a robot tax. So it means how much consumption I have to take away from the individuals in the economy to make them equally well off on welfare levels than they were before the introduction of the robot tax. And if this is negative, this means that we indeed have to take consumption away. So that means the tax made them better off. And if the compensating variation is positive, that means that we would actually have to give them consumption to make them equally well off than they were before the introduction of the robot tax. We plot this against the robot tax and show that starting from a robot tax of 0, actually the compensating variation is negative. That means that the robot tax in this framework would be welfare increasing. However, if we increase the robot tax further, at some point the compensating variation would become positive and the robot tax would become welfare reducing. The optimal robot tax is a little bit above 50% in our framework, and where it becomes negative to have in welfare grounds to have a robot tax, that's actually at the robot tax above 230%, which is possible in our case because we do not tax the robot stock, but the cost of robots, so we could add 230% to the price of a robot by the tax. But in general, the result is, and that's important, that the robot tax at moderate levels here would be welfare increasing. The reason is exactly that young individuals benefit to some extent from automation then, and they get the redistributed proceeds of the tax and can invest them, which would raise the capital stock in the economy and imply higher capital income for them via the robot tax and for the old generation. However, from some point onwards, if the automation tax, the robot tax becomes too high, it hampers capital accumulation again because the automation tax actually also reduces the rate of return on traditional capital. So overall, what we were able to show is that there is an explanation for why the effects of automation in the overlapping generations model are so different from the neoclassical growth model and from the Solow model. And that is basically because individuals save exclusively out of wage income in the first period of their life. But wage income is reduced by automation, and therefore investment cannot take off, and you cannot come to a situation of perpetual growth that is driven by automation in the overlapping generations framework. We also showed that this result is rather robust to many different generalizations, and that also a robot tax cannot break this result. However, a robot tax can be welfare increasing, and this stands in sharp contrast to the standard results that we know in the literature, the Chamberlain-Judd result that capital should not be taxed because it always reduces welfare. In our framework, we've seen that automation implies that the generally chart result breaks down and that actually capital taxation could be optimal in such a framework.